Why can trade timing be the most decisive factor between profit and loss? If simply having a trading strategy was enough, then all traders who had the right analysis should have succeeded in most of their trades. But the reality of the market is something else. In many cases, losses aren't due to incorrect analysis, but rather result from poor timing in entering or exiting a trade. Maybe instead of asking what strategy you have, we should ask when you use that strategy. Almost all of us have made the right decision at the wrong time at least once, and the result was an unsuccessful trade. Have you ever had such an experience? Write to us and tell us exactly what happened as a result. Many traders think that just having good fundamental or technical analysis is enough to enter a trade. But the market is always changing, and if your entry timing isn't in sync with the market phase, even the best strategy can end in loss. Imagine you want to buy because you've received a positive signal, but the market is in a correction phase or has low volume. In these situations, even if your analysis is correct, due to poor timing, the trade won't reach its target, or temporary fluctuations will force you out of the market. Many traders spend years trying to build their ideal strategy, combining indicators, backtesting, optimizing stop losses. But just when it comes time to execute, everything falls apart because they've neglected the most important factor: entry and exit timing. Even the best strategy, if executed at the wrong time, can lead to losses. For example, imagine you have a buy signal, but the market is ranging or it's right before an important news release. The result is getting stopped out for no reason and losing your confidence. Focusing solely on strategy without paying attention to timing is like driving with a great map, but on the wrong road. This is where the difference between a professional and an amateur trader becomes clear. Professionals know exactly when to use their tools. If you want to act more professionally in the cryptocurrency market and avoid making decisions under psychological pressure, this video is for you. How do you determine the right time to execute your strategy? Share your experiences with us. Let's go over a few key points to improve your trade timing. First, check the higher time frame before entering. Identify the overall market direction. The signal you see on a lower time frame might be against the main trend. Second, use tools like volume indicators, ATR, or important time zones. These help you understand when the market is actually moving and when it's just fluctuating. Third, stay informed about economic news and their release times. Trading close to news release times carries high risk, even with a correct signal. Fourth, learn to be patient. A professional trader is someone who knows that sometimes not trading is the best decision. Don't forget, good timing is a combination of art and science. It requires practice, recording your experiences, and most importantly, self-awareness. In your opinion, what is the most important factor for successful timing? Share your own experiences with us in the comments. Many losses are due to poor timing. That's why professional traders don't just ask what to buy or sell, but also when to enter a trade. If you can combine the right entry timing with mastery of market structure, news, and trading psychology, you've taken a big step toward becoming a professional. You need to know the most dangerous times to trade. Be sure to watch this video with a notebook at hand. In your opinion, during which trading session, London, New York, or Tokyo, can you trade with the highest win rate?